Secondary watch market dealers. Everyone's got an opinion. One group of people will tell you that the watch market is dead, floating face down in a backyard pool, and that they will soon cease to exist. And then there's others saying that dealers make too much money, which of course suggests the opposite and implies business is good and the future is bright. Let's settle this once and for all then. Here I have the published financial accounts of 4 randomly selected watch dealer enterprises here in the UK, and I am a former accountant, so I'm going to take a look at how much profit these companies reported in their latest financial statements, how well they managed their debt, and weigh up all of that in the context of the truly pitiful and small profit margins that most dealers work with. And by the end of this, whether you were within the watch market is dead camp or dealers make too much money camp, you may have to reconsider your initial prejudices. So for Company A then, we're provided with the balance sheet for the year ending or period ending 30th of September 2021. As we can see, 2021's figures are weighed up side by side with their reported figures for 2020. Now, the first thing I'm most interested in looking at as we read our way down this is their stock figures. So this basically is the value of the watches that they held in stock. So in 2020, you can see the value of their watches is £3.5 million. And that grew to 2021 to a figure of £5.5 million. So quite a considerable increase there. You can see that clearly this company have responded to the increase in demand on the secondary watch market for the products that they offer. If we look further down as well, cash at bank has also increased considerably, 872,000 held in 2020, and in 2021 that's increased to 1.7 million there. So that's quite a healthy situation. It means that the company is more liquid and can pay their current liabilities much better, and that's a good thing because their current liabilities, which is basically their debt that falls due within 1 year, has increased. So in 2020 that stood at 1 million and increased in 2021 to 3.1 million. So interestingly, the difference between these two figures is around 2 million, which is the same as the difference between these two figures here, which suggests to me that their increase in inventory is actually provided by their suppliers, you guys out there selling them their watches on credit. So potentially quite a clever business solution for this company. They have increased their stock without actually needing to even pay for it. Finally, let's have a look at the retained earnings. So this is the juiciest figure of all. Basically, that is the profit for the year. So in 2020, what we can see is a culmination of all of the previous profits that this company made comes in at 4,475,000. Now, it's important to say that this is the profit figure at the very bottom line. So after all costs, indirect costs, direct costs, dividends, taxes. So the difference between these two figures is the exact profit for year in the year 2021, which is £911,661. Let's turn our attention to Company B then and see what kind of money these guys made in 2021. Once again, let's have a look at stocks for this company. So in 2020, they had inventory of 128,000, and that grew to 2022 to 154,000. So again, responding to the increase in demand there on the secondary watch market. The next figure that I would want to look at though is their non-current liabilities. So these are debts that fall due after more than 1 year. So usually this figure includes either bank loans or loans provided to the company by the directors, and you can see in 2020 that stood at 50,000 and that increased to a whopping 141,000 there. So that's quite a heavy burden, certainly when it increases from 50 to 141,000. So clearly this company took a loan of some sort to cover that increase in stocks and meet the new demand. But what's most interesting, I think, is the profit or loss reserves, which is the same as the retained earnings in the last statement. We can see that in 2020, the culmination of all the previous years' net profit stood at £4,703, which is quite small, and decreased to £580, which suggests the difference between these two figures here actually is a loss for, I can't really write that. Yeah, a loss for 2021 of £4,123. So this company made a concerted effort to increase stocks, take out that extra bank loan, and yet made a loss in 2021, the peak of the secondary watch market, which is quite astonishing because I did actually believe this particular company to be quite large, quite reputable. And to the third company, Company C. Let's have a look at how well these guys did. So this particular statement is the balance sheet for the period ending 30th of March 2022. So that is literally a day before the market took a nosedive. So this should be quite interesting to see how this business performed at the peak before the proverbial started to hit the fan. So if we look at their stocks, again, this company responded, increasing their stocks from 3,185,000 to 3,472,000. We can also see that cash in the bank decreased, probably to partially fund that increase in stock between 2021 and 2022. What's also interesting is as well in this case that they have increased the credit limits that they had. So this is the non-current liability amounts falling due, debts falling due within 1 year. Potentially that increase in stock was covered by some suppliers allowing them more credit than before. And finally, let's have a look at that all-important retained earnings or profit figure. So the difference between these two figures in 2021 to 2022, there comes in at £256,701. So quite a considerable profit there of just over £250,000 made. Last one up then is Company D. Are we going to see more of the same here? Increases in stocks, increases in bank loans to cover that splurge in demand that we saw. The first thing that I would look at once again is the stocks. We can see that inventories grew from just under 6 million to 6.6 million in 2021, and so did the cash at bank figure. So that grew from 168,000 to 899,000 there between those 2 years. Quite interesting. Clearly they are wanting to fund that increase in stock or potentially other current liabilities. So let's have a look at that then. The amounts falling due within 1 year, the debts owing within 1 year has increased from a huge 4.8 million to 5.7 million in 2021. So clearly the clients of this particular company are quite trustworthy. There's quite a few of them allowing them significant credit there, a large proportion really. You know, if you have a look at the value of their inventory, 6.6 million, 5.7 of it is likely due to it being offered on credit. What's interesting here is the initial capital that this company invested. We can see from the beginning they invested £500,000, so they've got quite a lot of skin in the game, unlike some of the other companies where usually we saw £10 or £1 as that initial first investment upon the establishment of this business. Anyway, the profit and loss account, that's increased from 855,000 to 1.3 million, which means a profit realised for the year 2021 stands at just over £500,000, £512,992. Fair to say it's been a decent year for Company D. Watch market dead, floating in a backyard pool? I think not. During the peak of 2021 through to early 2022, I think we can say that, metaphorically speaking, the secondary watch market was more akin to a Prosecco fuel pool party with inflatables and pretty ladies. Now, however, following a market correction and a fall in demand, which has now stabilized, of course, the situation is less of a pool party and more of a quiet Sunday evening soak. I think we all just learned there that there are profits to be made in this industry, and I think it's quite inconceivable to say that we can suddenly go from a situation of some of those companies just analysed earning £900,000 in pure profit to suddenly becoming unviable as businesses. Yes, all dealers lost money on some inventory, but the strong performance of some of those there is testament to their hard work and several years worth of building a loyal client base, not just that sudden spike in demand. So for them, the events of the past year are merely a bump in the road, and I'm sure when we come to have a look at next year's accounts, they will absolutely reflect that. To the camp that believes secondary market dealers earn too much money, again, I think not. Whilst I won't reveal the names of the companies just analysed there, I have to say one of them in particular that I thought was a big and successful player in the secondary watch market actually reported a loss, and that came as a great surprise to me. So that brings me really to my final point, and that is the pitifully small gross profit margins that most watch dealers work with. For the majority of dealers, this percentage stands at a very small 10%. There are others as well, so-called backpack dealers without premises, who may be happy with settling for just 7%. And this, guys, is a gross margin. So that is before all expenses, all overheads, all the costs of running a company, the insurances, the costs of upkeep of a premises, a showroom, the heating and lighting, with bills going through the roof, as we know, in the past year. Let's put this 10% figure into context then. If I took my money and I set up a coffee shop, for example, that particular industry on average achieves a gross profit margin of 31%, nearly 3 times more. So I could potentially make nearly 3 times more return opening a coffee shop. Farming and agriculture brings an average gross return of 13.6%, which again is even more than what we aim for at Beat the Waitlist of 10%. And we've all seen Clarkson's farm, and we know the trials and tribulations that Jeremy Clarkson went through there and the very small profits that they make. Well, Mr. Clarkson, I've found an industry that makes even less than the farming and agricultural sector, according to these official published figures. So I'll leave you with this thought. Would you risk $10 to make $11 in a market where prices could potentially go the other way and you could lose money? Go check out beatthewaitlist-watches.com, and I'll see you next time. Thanks. I should go back to my finance job.